Welcome again, trend followers, to part 3 of this video series where we examine how, as diversified systematic trend followers, we can use Strategy Quant as a very useful tool to assist us in the portfolio creation process. Now, once again, apologies for any noise in the background. This COVID environment I'm working in presents some unusual challenges, despite my attempts to remove the noise. Unfortunately, I'm not a sound engineer and I only have limited capacity. So this series has responded to an issue faced by many retail traders who have a desire to follow the trend following path, but lack skills in programming. How can you jump on board the bandwagon of this robust and very successful technique, which has had a very long successful track record in the professional fund management circles without any coding experience? Now, fortunately, it is possible given the current tools that are now available to the retail trader, such as Strategy Quant. In this series, we've been exploring Strategy Quant and its Strategy Quant X or SQX platform, which is still under development, but under build version 128, and has a number of stable features that we can use to replicate most of the workflow processes that we undertake within the MetaTrader 4 environment. What this means for our forum members is that they can now be released from the shackles of Fred's initial programming requirement of core designs and undertake powerful workflow processes themselves from ground up to develop their own robust portfolio solutions. Now, part 1 of the series explored how we as diversified systematic trend followers are a very unusual breed of trader. We are a weird and very ugly mob that dislike the rhythm of a predictable market and prefer to operate in the exotic land of adversity described as the fat-tailed environment of the market distribution of returns. In this exotic domain, you need to throw away the familiar mathematical tools you might use in more familiar predictable environments, such as notions regarding a standard deviation of returns, concepts such as the rational investor and the efficient markets hypothesis, predictive assumptions such as notions of an expected return, comparative performance measures such as a Sharpe, arithmetic returns, and on and on and on. In this weird, unusual world, you start to realize what a load of baggage has been created by those scholars and mathematicians that myopically see the financial markets as being much less than what they actually are. Now, a myopic focus on the narrow domain of normality, or the domain of market equilibrium, makes it very difficult to actually see the benefits that we as trend followers reap in these very complex markets. In our world of non-linearity, we accept a far bigger domain that more accurately reflects the real financial markets. And in this domain that operates far from equilibrium, we can see where the traditional trader is trapped in their fictitious world of equilibrium and predictability. And we set our trading traps on the verge of this narrow domain where their models start to break down. This is the frontier of the financial markets, where the domain of equilibrium meets the domain of disequilibrium. In this more exotic landscape, we need to use different and unfamiliar mathematical tools that don't break down, such as sample distributions comprising multiple means and modes, non-ergodic methods such as the use of the geometric mean as opposed to arithmetic means, performance measures such as the MAR ratio in preference to traditional measures such as Sharpe or Sortino. In our world of extremistan, we are instructed by the physics of complex systems, not the abstract mathematical models that apply to simplified domains. Our mathematicians of choice come from those who recognise complexity for what it is, such as the ideas of Mandelbrot, Turin, and Taleb. Now, system change to us weirdos is not a gradual process. It occurs in jumps. In fact, we would argue that by far the most alpha in these markets arise from the outlier events in the fat tails due to their sheer unpredictable non-linear magnitude, as opposed to alpha of the small spoils that is traditionally harvested from the peak of the distribution in environments of market equilibrium. The same can be observed in other complex systems such as our natural environment. The fossil record demonstrates that the greatest change of all is not a linear sequential progression of change, but a very gradual history of change, occasionally punctuated by major disruptive events. So we as trend followers are the greedy but patient bottom dwellers in an ocean of traders that love to feast on the bounty of greatest change, arising from an entire vanquished predictive species that lie just above our heads, who sometimes get it very, very wrong. We understand that this complex system operates in a far broader domain than merely the domain of the shallow depths, and we therefore simply wait for the fallen to tumble our way when they realise that their appreciation of their narrow domain was just too familiar and too short-sighted in extent. We see things far more widely in a divergent world and pay strict attention to the fat-tailed environments. So what this all boils down to is a recognition that the rules of trading for a divergent price follower that navigates uncertainty, such as us, is almost the antithesis of the rules that apply to the convergent trader seeking a predictable future. Because of this, we need to throw out traditional processes and methods used by the mainstream trader with the bathwater, and only use those tools that are specifically devised for hostile, uncertain regimes that lie within these fat-tailed environments. So in part 3 of this series, back into SQX we go. So here we are. We left part 2 having investigated the data manager, which is here, and then providing a brief introduction to the custom projects feature of SQX, which is where we are now. So here we are in this custom projects function, and we are currently looking at the data bank, which is this section here, that contain the system solutions that have been sequentially generated by the workflow process, from build strategies through this process here to the final workflow process. And each one of these phases corresponds to a different data bank of results. So here in this results tab, we see 1,817 generated solutions that have passed validation criteria of this build strategies phase of the workflow up here. So the first thing we do is we look at the performance metrics over here of the validated solutions. Now in this template, we see that our solutions use a multi-timeframe approach of weekly and daily, the D1 and weekly here. If you remember back to earlier episodes, this was a requirement of the core trend following model that we are testing in this example. Now this is only one possible type of trend following model, and our need for diversification in this exotic fat-tailed world requires that we test many different core design models. This way we develop many different and low correlated methods of attacking the trending condition in the outlier zones. So moving on, scroll over to here, we see a number of curious information warnings by SQX that tells us that this solution possesses too little trades. Well, so what? In our divergent world, where we can be riding trends for very extended periods of any possible duration, when we nail those outliers and ride the tsunami, then it is not surprising that we have a low sample size per solution. Furthermore, we don't want our models to overtrade. If we choose a high trade sample size per solution, then it forces us back into that predictable convergent world of market condition where we simply don't want to play. We have a different way of increasing our trade sample size to conventional logic. We test our solutions across multi-markets to up the trade sample size per solution to reduce the possibility of a curve fit result. So while this solution here gives 13 trades over an extended period between 2007 up to 2016, we then take this to the multi-market phase of the process, where we apply the solution to 14 other liquid Forex markets, but we are getting ahead of ourselves. So in a nutshell, disregard that informational warning of SQX and progress on, my friends. So let's scroll over to some of the other performance metrics. What's this I see? I see a sharp ratio here. Well, yuck. That has no meaning in our world of trend following. So let us apply a different performance template that applies to our trend following world. And I'm going to use my RB default template, which uses metrics that make more sense in our land. So what do we have in our land? We have better metrics such as the Kalmar ratio, the compound annual growth rate, the winning percentage, the average win, the average loss, the maximum profit and the maximum loss per trade. So look closely, my friends. Can you see the core design logic of a trends following system shine through with these performance results? Well, that is no coincidence. That is because we have embedded those golden rules that we discussed in part 1 of this episode into every single solution that's generated by SQX. So in terms of average win, you see that the average loss is far smaller than the average win. So positive skew, here we come. The maximum profit is far higher than the size of the maximum loss. Welcome to the world of cutting losses short and letting profits run. Over here, we can see that the longest trade in days is far higher than the traditional hold experienced by the predictive mob. Now, all these metrics are good signs that we are doing things just the way we planned for in developing our core design first before we used SQX to develop variations around these simple trend following models. Now, the results tab, which is what we're looking at now, is just the first build stage of the process relating to this section here. As we step through the sequence of workflow tasks, the databanks relating to those particular individual tasks show how the sample size of the collection progressively gets narrower and narrower from 1817, 1764, 1474 down to 120, down to 44 and so on. We can see that we progressively hone in on the most robust solutions of the collection and importantly those that have been adaptively carved to respond to more recent market conditions. Now the trends of today are different to the trends of the 80s and the 90s. The market has become more efficient and the impacts of noise and mean reversion and how they shape our trend following experiences is different to what occurred in the past. Even though we operate in the land of fat tails, the noise and mean reversion clings on to those trending conditions to reshape them to a degree and make them more volatile today. So our process, our workflow process, allows for the adaptation in the nature of the trending condition over time. Now the results tab, which is what we're looking at now, is just the first build stage of the process relating to this section here. As we step through the sequence of workflow tasks, the databanks relating to those particular individual tasks show how the sample size of the collection progressively gets narrower and narrower from 1817, 1764, 1474 down to 120, down to 44 and so on. We can see that we progressively hone in on the most robust solutions of the collection and importantly those that have been adaptively carved to respond to more recent market conditions. Now, the trends of today are different to the trends of the 80s and the 90s. The market has become more efficient, and the impacts of noise and mean reversion and how they shape our trend following experiences is different to what occurred in the past. Even though we operate in the land of fat tails, the noise and mean reversion clings on to those trending conditions to reshape them to a degree and make them more volatile today. So our process, our workflow process, allows for the adaptation in the nature of the trending condition over time. So enough of the data bank. Let's now have a look at the build stage in more detail to quickly summarise the major features and, importantly, how we embed the core design features into our build process with our coding experience, and then let SQX do its powerful processing around those core design principles. So we're not going to go in too much detail here, as there is a fair bit to it, but we'll show you the major features. In the build phase of the process, we are looking for a symmetrical design of both long and short. We are looking for a few conditions as opposed to many variables of which to undertake our processing around. Remember, we are after simple trend following models as opposed to complex trend following models with many variables. The simpler design we have, the more capability that simple design has in navigating an uncertain future. A prescriptive design that has many variables that are too curve fit to past conditions inevitably fail when they go into more uncertain environments. So the simpler variables in your design allows you to navigate a far broader array of different trend following trajectories that may exist in this uncertain future. In relation to our stop loss, we make sure that there is a stop loss applied to every single one of our solutions. We also make sure that it is an ATR based stop loss. A profit target, well, that's a no-no in our trend following world. We don't apply a profit target, but we do apply trailing stops, which is our method of exit from our trending condition, but we'll get to that in a second. In relation to the data, you can see how in this particular test that is being undertaken between the periods 2006 up to 2016, we're using our cloned data for EuroJPY that basically converts Dukascopy data into our Pepperstone timeframe. We also note here that we are using an additional chart to our main chart, which operates on D1. Our additional chart we're using is the weekly chart, and if you remember back to that core design principle, you'll understand why we're using two charts for this methodology. In relation to in sample, out of sample, yada yada yada, we don't apply that technique for our particular process. That is more a process assigned to developing confidence that your models are not curve fit. Now, the use of our core design is a way we overcome this ability for our models to become curve fit. Furthermore, we are data hogs. We much prefer to use long-term data sets than to reserve some of that data for out-of-sample testing. So that's the date. We have the ability in SQX to have a range of different trading options, but in this instance the only one we need to remember is for this particular purpose we only want one trade per day per solution, and we want that trade to be assessed on the open of the bar based on the prior day's current breakout potential. In relation to the building blocks, this is the important part that we need to get a firm grip on in relation to those who don't have coding experience, who want to enforce a design logic into the workflow process that SQX will undertake variations around. So you can see that the range of indicators that can be used within SQX is huge. Now, if you allow for SQX to use its own indicator selections, you will find that more than 9 times out of 10 your solutions will be curve fit to either noise or particular market conditions. Now, as specified in part 2 of this process, we develop a core design principle that has multi-market potential, is very simple in nature, and we want to firmly embed that process into our modelling. So we are only using the ADX is rising condition here, which is, if you remember back to our core model, was one of the indicators we used. We do apply a 20% weighting here, which means that some of our models generated will apply this condition, but we also want variation without the ADX rising condition. But also what we want to do is ensure that we are applying the Donchian breakout technique. So in this case, where the bar opens above the highest after opening below. In other words, we are looking for a breakout condition here, and we want this to apply to 100% of our solutions that are generated by this process. Also, in the configuration of the Donchian models, we want to specify the range of variables that it will look at in relation to the look-back condition. So we want Strategy Quant to assess a look-back of between 25 and up to 2000, a very long-term look-back, using steps of 25 in its iterations to look for possible solutions for our quest for a diversification around this core trend-following model. What else do we need to look at? That's the highest high and the highest low. Now also, if you remember, in the weekly chart we used a moving average. So here we are. This 100% means that we want the weekly chart, in this instance, to apply a simple moving average. Now remember, this is not applied to the main chart, which operates on the daily time frame, but applied to the additional chart, which relates to the weekly time frame. And in this instance, we want variations that look at a range of a simple moving average of a 25 period simple moving average up to a 200 simple moving average in steps of 25. But this particular choice of moving average here is only applied to our weekly chart. So just from these selection here and specifying the weights of the parameters used, we can ensure that all of our solutions work around a core design principle as opposed to being randomly generated by SQX. In relation to our order types, we are only looking at a market entry, orders at market entry. We're not looking for limit stops in this particular model. We can look at enter at stop limits, but we don't choose to for this particular purpose of modelling. In relation to our exit types, well, as you all know, we don't use a profit target, but we do demand an initial stop using ATR-based methods for normalization purposes, so it has multi-market potential. And we also use a trailing stop, which once again uses an ATR-based method of determination for normalization purposes. We also might optionally test a move to break even condition using an optional as opposed to a required condition, and an optional trailing stop activation, which therefore allows a degree of price movement before the trail is actually implemented. So we give that variability or scope of variability, but there are certain things that we demand that must be present in all of our strategies. See, the trailing stop condition and the stop loss condition, all using ATR-based techniques. In relation to our money management, in this particular method of testing, during these early phases, we use a fixed percent of our account. Now, what this means that when we're testing over very long-term lookbacks, it ensures that our drawdown is scaled to our equity balance. If we applied a fixed dollar level of testing or a fixed lot level of testing, you will find that as our equity builds, our drawdown dilutes in relative terms. So therefore, for our testing purposes, we use a fixed percent of our account in the determination of our position sizing of our stops. Now, if you remember, our stops using the ATR uses ATR as a volatility mechanism, but also as a method to determine our position sizing. So in highly volatile markets, our position size is naturally decreased, and in less volatile markets, our position size is naturally increased. In relation to cross-checks, in the build phase, we can I undertake higher backtest precision. So if we go back to the data, you'll note that the original test is a quick test using the selected time frame only. So in this case, the daily, which therefore only looks at the open, high, low, close of the daily bar. But in my cross-checks, I then, once strategies have successfully navigated the faster method of time frame, I wanted to go to more precision once it's being validated on the prior method on the 1 minute data, just to because we use this stochastic minute data, it allows a more accurate result to be defined through this process. In relation to the ranking, we just use a very simple and fairly low validation criteria to make sure that we get a number of successful entrants passing this phase of testing. Now, this build phase therefore generates this 1,817 strategies that pass this criteria in this phase here. And you can see that you can go into the individual code associated with each of the solutions generated. In this case, I'll use Pseudocode here that allows me to quickly assess whether the core design is embedded in these principles. We can see that it's using a Donchian lookback of 25 in this instance, an ADX rising condition, the moving average for the weekly bar. It's using set at 100 lookback, etc., etc. So you can see that the rules applied in the golden rules are all enforced within each of these possible solutions that are generated. Now, that's the build phase of the project, and my computer's sticking. Here we go. So in the multi-market phase, so once these 1,817 results have been generated here, in the multi-market phase, we then say, right, now rather than testing on this single market, which in the case of our build was the Euro JPY, we now want it to be tested across a broad array of different Forex markets. So in the retest function here, we then apply those successful solutions that pass the build phase in a multi-market context. So if you remember in part 2 of this episode where we talked about grouping market data into asset class groupings because of the nature of CFDs and the impact of the bias of additional costs in our particular retail space, we want to make sure that our multi-market test for this particular solution in Forex is therefore only applied across other Forex markets. So we have 14 different liquid markets here to test this single strategy initially developed in Euro JPY to see if it has potential in a multi-market context. That's what this multi-market phase does. And then in the criteria it says, so provided it is profitable in at least 8 of these 14 markets, then it is regarded as having multi-market potential. This is another way of ensuring that with our solutions that have a low sample size per solution, we test it rigorously across other markets to make sure that it is not necessarily curve fit to that specific market condition. In the slippage phase of this test, we're looking at the impacts of slippage, because in our world, in this fat-tailed environment, the entry is under slippage influences. They're quite volatile regimes, and therefore the influences of slippage must not have a negative effect on the general nature of our strategies. So we test it with a significant degree of additional slippage incorporated into our cost assumptions, which therefore is a measure to ensure that whatever passes the slippage test is more robust in nature, but still can perform very powerfully. In relation to the full sample test, well, in our initial build phase and all of these previous tests, we took that on a sample that ranged between 2006 up to 2016. In our full sample, this is where we say, right, let's apply this now to a fuller sample, a more comprehensive sample, right up to 2019. This is just to make sure that in our mining phase, where we develop these core variations, that it has the ability to survive in this new market environment between 2016 up to 2019. Now, the recency phase of the workflow process is where we look at the last 5 years as a rolling look back. And this is where we assess how sharp those models are in the current market environment of the last 5 years, to ensure that our portfolios are always kept sharp in nature of the adaptive markets, which we've discussed previously. In relation to our Pepperstone full context, what we then do is, this is where we take our strategies to the very long-term environment of the past 30 to 40 years. This is to ensure that any of the solutions generated during this prior phase over shorter range data between 2003 up to 2019 now has the ability to navigate the 20 years prior to that environment in an unfamiliar zone. This is effectively a test of robustness. And those models that meet all of the prior criteria, as well as the robustness phase and recency phase, therefore we've narrowed down to a handful of those particular robust and fine-tuned models that we want to take into our portfolio compilation phase. So following the Pepperstone test in our workbank, we see that we have 44 strategies that we now need to consider for inclusion into a portfolio. Now, because these strategies are processed for Euro JPY, we want to operate across a diverse range of different markets. So we apply this process to our core models for every single market in our universe. And in this case, we might be applying a universe of 40 different markets, of which 15 are Forex, 15 are commodity CFDs, 10 are index CFDs, and we might have some cryptos in there as well, such as Bitcoin. In relation to this, we have 44 solutions that are eligible for Euro JPY. We need to reduce that back to, say, the top 5 in relation to their robustness and recency, and in how they marry together as a collection of 5 separate solutions into a robust portfolio. And this is where we need to look at the correlation that exists between all of these 44 solutions. So this is probably the end of this video, as we're starting to run out of time, and this has been a pretty long one. So in our next video, we'll show you how we use Quant Analyzer to assess these 44 solutions that have been identified through this process, and how we compile them into the top 5 solutions that offer best bang for buck as a comprehensive sub-portfolio for Euro JPY of a broader combination portfolio that spans across asset classes. And in that phase, we'll step into Quant Analyzer, which is our preferred tool for identifying what are the best solutions within in this example, 44 that have been developed by this workflow process. So stay tuned for the next episode, which will be available in the next couple of days. It's a long process, gents, but it's a worthwhile one. So thanks for listening, and have a great trading day.